If you think returns alone define a smart investment, you're only seeing the upside. Because when serious capital is deployed, the real focus shifts to downside protection, how risks are contained, how assets are separated, how defaults are handled, and how investor rights are enforced. In the earlier section, we covered the intermediate level of corporate structure. Now, we move into the advanced level, where investors evaluate the legal strength behind the investment. This is where capital looks for resilience, not just returns. Let's get into it. One are SPs, bankruptcy remote entities. In our structure, SPVs are separate legal entities with ring-fenced assets and liabilities, which helps contain risk at the project level. However, it's important to be clear, they are not guaranteed. Bankruptcy remote, in the strict legal sense. What we actually insure. 1. Each SPV, each owns its project asset property and has its own liabilities NCDs. 2. There is no cross-collateralization between SPVs. It means that the assets held by one SPV cannot be used to secure or pay back the debts of another SPV. 3. Funds and cash flows are not pooled across projects. In the future, each project operates as a segregated financial unit. Investor protection in practice. 1. A charge is created over the SPV's asset in favor of the debenture trustee. 2. In a stress scenario, enforcement is against that SPV's asset, not the broader business. We don't claim legal bankruptcy immunity. Instead, we ensure practical risk isolation. Bankruptcy remoteness depends on multiple legal factors, but our structure follows standard SPV-based risk segregation used in real estate financing. Each project is legally separate, so risks are contained within that project, not spread across all investments. The structure is designed for risk containment, not assumption of zero risk. 2. How is inter-SPV liability managed legally? Inter-SPV liability at GHL India asset is managed through strict legal separation and non-cross-collateralized structuring. Each SPV is a standalone legal entity, and its assets and liabilities are limited to its own balance sheet. How this is achieved in practice? 1. Separate legal entities. Every SPV is incorporated independently under the Companies Act 2013. It has its own directors, own financials, and own contracts. This legally separates one project from another. 2. No cross-collateralization. Assets of one SPV are not pledged for another SPV. Investors in one project have rights only on that project's asset and are not exposed to liabilities of other projects. It prevents risk spillover. 3. Ring-fence cash flows. Each SP operates through its own bank accounts, its own inflows as sales proceeds, its own outflows, investor payments. It prevents fund mixing. 4. Independent security structure. Each SPV issues its own secured NCDs, creates its own charge in favor of the trustee. It ensures investor rights are project-specific. Each project stands on its own. No project is legally responsible for another. There are no cross-guarantees or cross-default obligations across SPVs. There is no cross-risk. Every investment is ring-fenced. 3. What legal framework ensures separation of assets between SPVs? The separation of assets between SPVs at GHL India asset is ensured through a combination of corporate law, contract structure, and security creation mechanisms. 1. Separate incorporation under law. Each SPV is incorporated as an independent private limited company under the Companies Act 2013. This means each SPV has its own legal identity. Assets are owned in the SPV's name, not at group level. Liabilities are confined to that entity. 2. Asset ownership at SPV level. The property is purchased in the SPV's name, reflected in its balance sheet. Legally, this ensures one SPV cannot claim or access assets of another SPV. The 3. Independent contractual framework. Each SPV enters into its own sale agreements in deeds, investor agreements NCD issuance, trust deed with debenture trustee. This ensures there is no shared or overlapping contractual rights across SPVs. 4. Security creation charge registration. A charge mortgage is created on the SPV's asset. This charge is held by the debenture trustee, registered with the Ministry of Corporate Affairs (MCA). It gives investors legally enforceable rights on that specific asset only. 5. No cross guarantees or cross charges. One SPV does not guarantee obligations of another SPV. No shared collateral between SPVs. It prevents legal entanglement and contagion risk between projects. Each project owns its own property, has its own agreements and deeds, and its own legal structure. Nothing is shared between projects. Asset separation is not assumed, it's legally built to the structure. The separation is ensured through company law, contractual structuring, and registered security, not just internal policies. 4. What happens to investors if one SPV fails? If an SPV underperforms or fails to meet its obligations, the impact is limited to that specific project and a defined recovery process is triggered. What happens structurally? Each SPV is a separate legal entity. There is no cross liability with other SPVs. So, other projects and their investors remain unaffected. Investor protection mechanism step by step. 1. Security exists on the asset. The underlying property as owned by the SPV, mortgaged to the debenture trustee. So, investors have a legal claim on the asset. 2. Trustee steps in. The debenture trustee represents investors, initiates enforcement if needed, takes control of the secured asset. 3. Asset monetization recovery. Property may be sold, liquidated, restructured. Proceeds are used to repay investors. 4. Distribution to investors. Repayment is done based on debenture terms. Legal priority. Recovery timelines and amounts can vary depending on market conditions and asset liquidity. Your downside is linked to the asset, not just the company's promise. If a project fails, investors don't lose everything. The trustee can enforce the property and recover value from the asset. Even in stress scenarios, investors have enforceable rights through the trustee and asset security. So far, we have maintained a 100% repayment track record with no defaults. While past performance is strong, we structure for investors' protection in all scenarios. 5. How are cross-default risks across SPVs managed? At GHL India Asset, cross-default risk is minimized through structural independence and non-linked obligations between SPV. Each SPV operates as a standalone financial and legal entity, with no automatic linkage of default across projects. How cross-default risk is controlled? 1. No cross-default clauses. Default in one SPV does not trigger default in another SPV. Each SPV's obligations are independent. 2. No cross-collateralization. Assets of one SPV are not pledged for another SPV. Security is strictly project-specific. This prevents chain reaction of defaults. 3. Separate debt structures. Each SPV issues its own secured NCDs, has its own repayment schedule. There is no shared debt exposure. 4. Independent cash flows. Each SPV operates its own bank account, its own revenue, property sale proceeds. There is no dependency on other SPV projects. 5. Trustee level monitoring. Debenture trustee monitors compliance of each SPV individually, security and repayment structure of each SPV individually. If one project faces issues, it doesn't trigger a chain reaction. Each investment stands on its own. Every project is structured independently. Separate company, separate asset, separate cash flow, and separate risk. There is no domino risk because every SPV is independently structured. We follow a non-cross default, non-cross collateralized structure, which is standard in institutional real estate financing. We hope this has strengthened your understanding of the advanced level of corporate structuring. Next week, we move into the basic level of business structure, where we explain in a simple way how the business earns profits. We'll cover how properties are bought, improved, and sold for value, why Tier 2 cities offer strong opportunities, who buys these properties after redevelopment, and how distressed assets are turned into returns. Stay with us. Because when you understand how the business works, you understand how value is created.